2025 for me was a year of action, pace and movement. For markets, it was a year of high velocity movement. Markets moved, sentiments moved, and money moved. So let's begin with the scorecard of 2025. On the first trading day of the year, 2nd January 2025, the Sensex stood at 79,944 points. And by the final trading day of the year, 31st December 2025, it closed at 84,675 points, delivering a gain of about 6% for the calendar year. The Nifty started 2025 at 24,189 points and ended the year at 26,130 points, delivering a return of 8% for the calendar year. Now, this market performance was delivered despite significant cross currents, including substantial foreign institutional selling of approximately 1.6 lakh crore or $18 billion, which was driven by global rate pressures and valuation concerns. With that context in mind, today's Signal episode is about understanding what truly moved markets and what shaped investors' experience. We break 2025 into three clear layers: sector movers, earnings signals, and market shakers. Welcome back to Signal, where noisy markets meet simple, sharp, and sound insights for long-term investors. If 2025 left you questioning, why did my portfolio feel uneven even though markets were up? You are not alone. One of the clearest takeaways of 2025 is that participation was broad, but returns were selective. Public sector banks emerged as prominent movers. Asset quality improved to multi-year lows. Credit growth remained in double digits, and operating leverage lifted profitability. Balance sheet repair and improvement translated into earnings visibility and sustained confidence. Metals and materials followed as infrastructure activity, policy support, and improving commodity momentum strengthened towards the latter part of the year. Autos also contributed, supported by demand visibility, product cycles, and policy cues. 2025 also delivered a timely reminder that policy shifts can reprice sectors very quickly. In a nutshell, 2025 underscored a clear hierarchy. Fundamentals and earnings visibility matters more than popularity, and conviction more than comfort. And that takes us to the next layer. What did markets consistently reward in 2025? As sector patterns emerged, earnings shaped the outcomes. Earnings were quiet movers beneath market action. Repeatable, visible earnings drew capital and sustained momentum, supported by improving efficiency and stronger balance sheets. And contrary to it, earnings uncertainty acted as subtle shaker. Where visibility weakened, price action became more sensitive to news flow and short-term triggers. The takeaway from 2025 is that earnings quality influences both returns potential and resilience. Several forces tested portfolios through the year. Elevated foreign institutional selling remained persistent shaker, while domestic participation supported market progression. Policy actions influenced sector outcomes with swift repricing as assumptions changed. The cigarette excise announcement led to swift and decisive repricing across FMCG stocks, emerging as key market shaker. Markets reacted first, with the impacts gradually filtering through the smoking cohort. Global trade and tariff developments added to the shaker sentiment, particularly for globally exposed sectors. Together, these shakers could not halt market progress, but they did test investors' conviction and portfolio structure. So the real question is not whether markets progressed, but whether portfolios were built to withstand the test. As we look ahead to 2026, research commentary reflects measured optimism rather than exuberance. This outlook is anchored in expectations of earnings recovery, and valuations that remain broadly reasonable following the recalibration in 2025. Several global investment banks like Goldman Sachs, HSBC, Morgan Stanley see base case scenarios where the Sensex is expected to move in the range of mid 90,000 by the end of 2026. Domestic brokerage research echoes this view, suggesting the Nifty could trend towards late 20,000, implying steady compounded style returns rather than sharp acceleration. The potential key movers remain familiar. Financials aligned with the credit cycles, consumption-linked segments like autos, manufacturing and capex-linked themes. The research also remains mindful of possible shakers, policy shifts, global macro developments, and phases of volatility. With markets shaped by clearly identified movers and tested multiple shakers in 2025, the natural question is, how should investors position their portfolio for 2026? To help us address this question, here is our founder, Himanshu Pandya.
How do you think about your portfolio in 2026? As we step into 2026, the most important question for investors is not where markets will go next, but how portfolios are positioned to navigate whatever comes next. Markets will move, cycles will rotate, volatility will appear. What matters most is whether a portfolio is aligned with your goals, time horizon, and risk capacity. Portfolio thinking in 2026 is about alignment. And that alignment looks different at different stages of life. Let's say if you are a beginner investor, if you are entering the market in 2026, the priority is not timing, the priority is structure. A diversified core portfolio across equity, fixed income, and selective global exposure matters far more than chasing themes. The focus should be on broad market exposure, consistent investing habits, allowing compounding to work over time. An illustrative allocation could look like this: 2/3 in equity, diversified large and flexi-cap equity funds, 20 to 30% into fixed income with high quality debt and stability, global equity 5 to 10% with good geographical diversification, gold or alternates up to 10% of the portfolio. At this stage, simplicity creates clarity, and clarity builds confidence. But if you are an investor with 10 plus years of experience, the theme for 2026 is to review, rebalance, and realign. Over time, portfolios drift, sector weights change, risk exposures evolve. Disciplined rebalancing ensures that portfolio reflects today's goals, not yesterday's winners. An indicative allocation may include equity, almost 60 to 70% again, across large, flexi, and selective mid and small caps. Global equity now can go right up to 15 to 20% or higher than beginners for cyclical diversification. Fixed income, volatility stabilizer, and a liquidity anchor, 20 to 30%. And alternates or gold, up to 10%. At this stage, intentional review keeps long-term success on track. If you are near retirement or retired, for retirees, portfolio thinking in 2026 must prioritize stability, liquidity, and predictability. A practical approach is a bucket strategy. A liquidity bucket with 10 to 15% for near-term expenses, income bracket of 40 to 50% in steady cash flows. Growth bucket, 25 to 35% inflation protection. Gold or alternatives, 5 to 10%. The structure allows spending from stable assets while giving growth assets some time to work. One last word. Across all stages, one principle remains constant. Portfolio construction matters more than market forecasts. And in volatile years, working with a SEBI-registered investment advisor helps structure portfolios aligned to life, not to headlines. Quite simply, Sone pe Suhaga. Thank you.
As we step into 2026, we wish and pray the year brings you movers that support sustainable profit making, shakers that reward discipline and conviction, and signals that point towards long-term abundance. As we close this chapter of Movers and Shakers of 2025, we return back to our sectoral exploration from next week. We are building a strong community of methodical movers and sober shakers. If you're one of them, why not like and subscribe us and tell us in comments which investment habit you wish to adopt in 2026.